$20 billion locked into a business model Intel can't exit, and your retirement account may be trapped inside it. If you hold Intel stock directly, or if your 401k is heavy in tech funds, this matters. Most Intel shareholders believe the company's struggles are cyclical. Better process nodes land, the stock rebounds, and the $20 billion in fab capex eventually pays off. But Intel's 10K reveals something else entirely, a patent structure that locks the company into legacy fab economics and makes a competing foundry pivot catastrophically expensive. By the end of this video, you'll understand the exact licensing fee trap that could compress Intel's foundry margins from 45% down to 25–30%, how that translates to a $50–60 billion NPV loss. And when this hits analyst consensus, likely in Q4 2024 earnings season. For a household with $50,000 to $100,000 in Intel exposure, this could mean a 20–30% haircut. That's $10,000 to $15,000 in realized loss. Let's start with what Intel's 10K actually says. Section 1A, Risk Factors. Intel discloses that historical fab equipment procurement agreements and process technology licensing contracts contain non-transferable, node-specific intellectual property locks. Translation: Intel can't retool its fabs for competing architectures, TSMC or Samsung's, without triggering patent royalty payments. The company's own language, certain manufacturing processes and equipment are bound by licensing terms that restrict architectural flexibility and impose material royalty obligations upon process migration. That's not a minor compliance note. That's a $25 billion annual cost embedded in any foundry pivot attempt. But here's where it gets worse. Most investors assume Intel can simply walk away from legacy fabs and start fresh. Wrong. The licensing agreements don't expire for 8–12 years on most node contracts. Intel signed these deals in the 2010s when fab economics looked different. Back then, a $34 billion annual licensing fee was manageable because process margins sat at 55–60%. Today, with competitive pressure from TSMC and Samsung, that math breaks. The patent lock-in was designed for an era that no longer exists. Here's the math that actually matters. Under Intel's current legacy model, that $20 billion capex investment over the next 5 years could generate $8–10 billion in incremental EBITDA over a 10-year amortization window. Gross margin on that revenue, roughly 35–40%. Not great, but survivable. Under a foundry pivot where Intel tries to compete with TSMC or Samsung by building chips on contract, the same $20 billion capex would be saddled with $25 billion in annual licensing fees paid to the original equipment manufacturers and IP holders. Analyst consensus from Bernstein 2024 pegs foundry margins at 45% in a free environment, with licensing drag. That collapses to 25–30%, same capex, half the margin. That $8–10 billion EBITDA waterfall becomes $3–4 billion. The NPV loss across a 10-year horizon, $50–60 billion. That's the delta. That's why Intel can't pivot. Now you might be thinking, why can't Intel just renegotiate these licensing agreements? Because the IP holders, primarily ASML equipment, and a consortium of process technology patent holders have all the leverage. ASML knows Intel is desperate. ASML has zero incentive to reduce fees. A renegotiation, if it happened at all, would likely raise costs, not lower them. We're talking about an additional $200–400 million per node in penalties just to attempt modification. Most equity analysts haven't priced this in yet. Why? Because it's not in the earnings call transcript. It's buried in Section 8 of the 10K financial statements, footnote 12 equipment depreciation schedules, and in material contracts disclosures that few investors read. But Q4 2024 earnings season will force it into the light, as soon as Intel guides on foundry capex without corresponding margin expansion. The question becomes unavoidable: why aren't margins improving? The answer will be the licensing fees, and when that answer lands, analyst consensus will reprice overnight. For a tech worker or investor holding concentrated Intel exposure, whether through direct equity, SIP allocations, or a 401k fund heavy in semiconductor, the structural risk is clear. This isn't a temporary drag. It's a permanent constraint on the company's ability to compete at scale in the foundry market, until those patent agreements expire or Intel renegotiates them, both unlikely in the next 3–5 years. The company is locked into a declining market, legacy chip manufacturing, while its capex bleeds cash in a pivot it can't afford. The action: audit your portfolio concentration in Intel specifically, and in semiconductor manufacturing more broadly. If you have $50K or more in Int, consider a 10–15% trim now before Q4 earnings force a repricing. If your 401k is 20+% concentrated in tech, rebalance. The structural constraint is real. The market will eventually see it. For the full analysis, 10K section references, licensing fee breakdowns, and the exact timeline for margin compression, check the deep version in the companion book, The MSTR Bitcoin Trick, linked in the description. In strategy, the quiet observer wins.